Tenaz Energy, based in Calgary, focused on acquiring and developing oil and gas assets in Canada and the Netherlands, just reported third quarter earnings. That stock has been climbing. Let's get more from Tony Marino, President and CEO at Tenaz. Tony, great to talk to you again. Thanks very much for joining us. We'll have a look at the stock because it has been climbing despite weak oil prices. Tell us, where's most of your production coming from right now?
Andrew, it's a pleasure to be back. The vast majority of our production is in Netherlands, offshore, and that constitutes about 85% of the production in our company. We have a nice asset in Canada, but it's relatively small in comparison to the rest of our assets. And really, most of our growth is going to be in outside of Canada as well, Netherlands and potentially other locations.
And is it natural gas in the Netherlands?
It is. It's 99% natural gas, TTF gas, priced at about 15 Canadian dollars per MMBTU right now. A very small component of condensate with that.
Do you actually operate the rigs, or do you buy into assets operated by other people, Tony?
We have both. The big majority of our assets in Netherlands and all of them in Canada are operated. We do prefer to have control of the operation. Mm-hmm. We did recently announced early October the acquisition of a non-operated interest in a new asset offshore Netherlands, right at the Netherlands-Germany maritime border. It's a very high quality production base and a number of great already discovered fields that can be developed and some very good exploration prospects. It actually is non-operated. Mm-hmm. We're comfortable with this in this case because the operator there, Juan Diaz, is very closely aligned to our philosophy, and we think we'll do a very good job developing these fields. Mm-hmm. But the majority of what we have is operated, and in general, that is our preference.
When you go in to buy assets in Europe, do you find, there's other bidders. How can you be sure that, you're offering the most money. How can you be sure that you're getting value? You've been around for a long time, Tony. I know you have good people working with you. But if you're willing to pay more than other people, you feel that you know more than them? Or, well, I guess different people have different models.
Well, that's a very true statement, and it's a great question. There's maybe three ways, I think, to answer it. First of all, we do have a very set, tried and true, technically based methodology for evaluating the assets that we're looking to buy. Mm-hmm. We project every single well, every single project internally. We back this up with an independent evaluation by our reserve firm, McDaniel and Associates. So we end up with actually two, I think, qualified evaluations to give us a good technical picture. Mm-hmm. And when we have a good technical projection, we try to take sort of the controllable risk out of the equation. You still have price risk. A second factor is that in these international markets, oftentimes there are not very many practical or qualified competitors. Either they don't have the financing, they don't have the operations background, they don't have the sustainability background to have the big company sellers be confident in placing the assets with those companies. And so really the competition, the practical competition is usually very, very limited. And that's actually key to making good returns in M&A. A third factor I'd point out is, at least in talking to the sellers, in a number of cases, we aren't the high bidder. But again, because of the qualifications that the company has, their confidence that we can actually close the deals, we can get the necessary approvals from the governments to buy the assets, they will go with us, even though oftentimes, as we are told, we are not the highest bidder.
It's interesting. What about shutting down liabilities, environmental liability, when an asset has reached the end of its life? I guess that's a factor too.
Certainly it is, and it gets factored into these evaluations, our assessment of the value of the properties and the price we would pay and how we would structure the transaction. All of the assets do have decommissioning responsibilities that go with them. We're going to take care of all of those, and actually our capability and our reputation, our commitment to that is a key factor, again, going back to your previous questions, in making these deals. There are ways oftentimes to reuse these platforms CCS is one possibility. And so we're going to seek reuse wherever possible. And another factor is that we very much intend to extend the producing lives of these offshore assets. And when you do that, you still have a decommissioning responsibility at the end, but you've generated way more cash flow, way more net present value out of the assets by extending the life. And also in a discounted value sense, you reduce the NPV of that decommissioning responsibility by pushing it out further into the future. So these are all ways in which we would deal with that, in addition to just trying to do it as efficiently as possible with economies of scale and as much creativity that we could use to hold down the cost of it when that decom occurs. Certainly, we're going to fully discharge those liabilities. We're going to take responsibility for the abandonment, and that's actually key to our model as well.
And just remind, I'm just checking out here, the stock has jumped this year, Tony. Your shareholders are happy. It's up 82%. Your market cap around 730 million Canadian. What will your debt level be at year end? Can you give us a rough idea?
Yeah, pro forma for the recent acquisition of the new assets in Netherlands, our debt level is 360 million Canadian to go with that market cap that you just quoted. So I guess we have around a 1.1 billion Canadian EV now.
Right. Tony, always great talking to you, and thanks very much.
My pleasure. Thank you.
Tony Marino, President and CEO at Tenaz Energy.